Hi everyone, and thanks for joining us for Maximizing Your Match. I'm Ed Wochton, a retirement plan consultant here at Clearview Advisory. Today we're going to talk about getting the most from your employer's matching program. We're going to highlight a few ways that allow you to receive the maximum amount that you can from your employer in your company's retirement plan. This is essentially free money that'll help your retirement account grow exponentially faster. It's a fantastic benefit that we strongly encourage you to take advantage of if you aren't already. Match amounts and calculations vary from workplace to workplace, so if you don't know your organization's matching program, we encourage you to find that out. In almost all workplace retirement accounts, there are at least two types of money going in. Your contributions, commonly referred to as pre-tax or Roth deferrals, and then you have your employer match. What I'd like to do now is review how to calculate your contributions in order to get the maximum match from your employer. In this example, and for all examples today, we're going to be using a simple match of 3%, meaning your employer will match your contributions up to 3% of your paycheck. So if your biweekly check is $3,000 and you're contributing 6% of each paycheck, then your contribution will be $180 per pay period. Your employer will match 3% of each paycheck, or $90. So while it seems easy enough, there are certainly a couple of different ways that can trip us up, and we can potentially lose out on some of our employer match. So here's our first tip. You can save more for retirement by spreading out your contributions throughout the year. Let's look at a couple of examples that'll help us do that. So here we have Kelly. Kelly makes $100,000 a year. She contributes $1,000 a month into her 401k. Her company match is 3% of her salary per paycheck. Kelly spreads her contributions evenly throughout the year and receives the maximum match available from her employer. Kelly saved 12% of her salary, or $12,000, and she has gotten the full 3% or $3,000 match made available to her by spreading out her contributions evenly throughout the year. Let's consider another example. So here we have Harry, who wants to contribute the maximum amount possible to his 401k as allowed by the IRS. Like Kelly, Harry's salary is also $100,000 a year, and his company matches 3%. Harry front loads his contributions, meaning he puts in as much as he can afford each month until he reaches that IRS annual limit. In this example, he reaches the limit in the month of May. The thing is, Harry is saving more than enough money, so he should be eligible to receive the maximum annual match of $3,000. However, by front-loading his contributions, he is not getting the company match from the months of June to December. In this example, Harry is missing out on $1,750 in company match contributions. So easy question, who got the most from their match? Kelly is getting more in matching dollars despite putting in less than Harry. She gets the full 3% of her salary. So let's go ahead and review another common situation for people who get an annual bonus. Many of you may get an annual bonus, and it's smart to consider how it factors into your contribution strategy for the year. Here's how to use your bonus if you're trying to maximize your contributions. For this scenario, let's get to know Amy. She makes $200,000 a year and wants to contribute up to the IRS maximum, but she also wants to receive the maximum amount of employer contributions that she can. She contributes 10% of every paycheck and receives a $50,000 bonus in the month of January, and also contributes 10% of that $50,000 bonus. With this strategy, Amy reaches the IRS maximum early and does not make any contributions the rest of the year. And that means she's missing out on the matching dollars for the rest of the year, even though she's contributing more than enough annually to qualify for it. Remember, Amy received a $50,000 bonus in January, and in this scenario we're showing Amy uses her bonus to make her entire deferral for the year. So she puts the maximum amount into her account that she can for the month of January and doesn't have to put another nickel in for the rest of the year. Seems like a good idea, right? Well, unfortunately, it means Amy does not get the matching contributions from her employer the rest of the year either. With this strategy, Amy misses out on more than 90% of her matching dollars that she could have received. So what should Amy do? Well, Amy can save more money by contributing enough to get that match each and every month. That means spreading out her contributions and not using her bonus to bump up her deferrals too much. I know some of you are wondering, are there situations where it makes sense to use your bonus? And it absolutely does. However, for today's purposes, we're keeping it simple. Here are some next steps to ensure you receive the maximum match available. First, take time to evaluate your savings goals at the beginning of the year. Based on your base salary, bonus, and your company's matching program, what is a realistic amount of money for you to defer into your retirement account? Next, Figure out how many pay periods there are in the year and how much money you will receive in each of them. This should also include your annual bonus if you intend on contributing money from that as well. Then, using your annual savings amount in dollars, calculate what percentage you need to contribute each pay period. One of the easiest ways is to contribute the same dollar amount from each of your paychecks, but this may vary depending on your personal situation. We went over a lot of information today, and we know this can get complicated, especially when you're applying it to your own situation. The good news is we're here to help. Please reach out to us should you have any questions. So that's it for today. Thank you for talking with me about saving for retirement.